All right, we are back for another Friday financial wrap up with Mr. Michael Zuber. How are you, Michael?
I'm doing well, man. I look forward to these conversations every week. It's a way I can look back over an exciting 5 days and go, what the heck happened? So thank you for the opportunity.
I love it. I love it. So this is for January the 19th, 2024. I'm going to tease the show. You said something, I kind of almost fell out of my chair and choked a little bit. Trillion dollar defaults. We're going to talk about that toward the end. But let's get into the show. The Fed. What Fed speak? What happened this week with the Fed? And what is your points? What are your thoughts about the Fed this week?
Yeah. So one of the important things to understand is the federal, the 18 Fed presidents, they get invited to speak a lot. And what was important for us to figure out is, I think, one of three things, because they say lots of words to lots of people, but I only think three things matter. One, is any of them talking about raising rates, or are we done? Two, are any of them talking about cutting rates? And if they are, in what time? And three, are they talking about potentially higher for longer, meaning no cuts in 2024? Those are the three things we have to listen to. We had at least 8 Fed speeches that I found, and maybe more. And near as I can tell, there is one or two talking about potentially a higher terminal rate. What does that mean? Raising rates. Again, I think it's talk, it's speak, but the answer to question number one is yes. There is at least one Fed president, I think it was Bostic from memory, saying, you know what? I may have to revise my peak for terminal rate, AKA, we may have to go higher again. Number two, anybody talking about cuts? Lots of them are talking about rate cuts in the second half. None of them are talking about rate cuts as soon as March. And then lastly, did anyone talk about higher for longer for the year? Near as I can tell, none of the Fed speeches talked about that. Again, they're trying to pull the market away from a March rate cut, in my opinion. And as we will get into the data later, I don't know. Are they right? Are they wrong? We'll look at the data together in our next couple of bullet points.
Very interesting. Very interesting. And it's interesting that just when you refer to the market, I want to just clarify for the viewer, for the listener, we're talking about Wall Street. We're talking about the stock market, and they're really depending, hoping on, counting on a March Fed rate cut, which basically keeps the stock market ripping and roaring. Is that pretty accurate?
Exactly. I think the last time I saw it, the odds of a March rate cut were north of 60%. And they got as high as almost 80%. I think it peaked at 78%. So yeah, the smart money, the big money, whatever you want to call it, Wall Street money, still have Fed cutting in March as being the base case. So I think the Fed is working hard, i.e., Fed speak, to pull the market to May or June.
Interesting. So potentially just resetting expectations. We'll talk more about that also toward the end. Let's talk about retail sales. What happened this week? Your thoughts?
Yeah. So again, right, in order to get a March rate cut, you would really have to have the consumer stop shopping, right? We are a consumer based economy. 68 to 70% of the economy is consumer spending. And we got December numbers and they were up. They were, in fact, if memory serves, the highest in the last 10 months. I think they were up 0.8. Expectations was 0.4. There's the death of the consumer has been often mentioned, but not showing up yet. So again, I think retail sales really points to how the heck can you cut rates if the consumer is still spending? So, a point for the Fed, at least on that bullet point.
Very interesting. I'm going to change the order on what we talked about in the show notes. So
Okay.
that really leads me to, okay, so the numbers were better on retail sales, the strongest of the last 10 months. Is that accurate?
Yeah.
Okay. So that goes to something we haven't talked about in a while, which is credit card debt and specifically Discover Financial. You talked about it in the daily financial news the other day. What tie that all together? What do we see with Discover Financial?
I'm glad you added that. That was a very nice catch on your behalf. One of the things that was important for us is to watch credit cards, right? Because we have often heard, or it's been reported, that we have over $1 trillion in credit card debt, highest on record. So the beauty is we get reports from credit card companies who will reserve and report bad debt. So Discover Financial last year reserved $900 billion for bad debt, or 900 million. Sorry, 900 million. 900 million, not billion, million. This year, they reserved 1.9 billion.
More
So an
than double.
increase, more than double, 116%. They talked about 90-day lates spiking to like over 4% or some crazy number. So retail sales, still shopping. Discover Financial, we'll get more from Visa and MasterCard later, but are really saying, you know what? The consumer starting to show cracks, at least a segment of the consumers. Because once you get into, hey, defaults are coming, you have to figure out what consumer base, is it high risk, low risk, all of that. But again, as we are trying to put together the picture of the economy in real time, retail sales good. Discover Financial, again, one data point, not very good.
Very interesting. And of course, and I brought that there because those two really, maybe they go hand in hand. Retail sales are good because of the credit cards.
Could be.
Could be a correlation there. Very interesting. Let's keep going. So let's talk about home builders. What did you see this week with home builders? Your thoughts about it?
Well, let me ask you this, Ty. If you are a home builder and rates fell 1.5%, would you be in a better mood?
Much better mood.
Guess what? The data validates the home builders are in a much better mood. So yeah, again, we get a monthly home builder report, and yeah, home builders are in a much better mood. But interestingly enough, they're slowing down building. Right, the products that they're delivering are less than, again, the previous month. So, yeah, home builders are sitting in a pretty good spot. Rates are down. Their buy downs have to be less. They're not having as much delivered, so the demand meets supply. Also, there's reports of the supply chain loosening up and suppliers letting builders buy more stuff cheaper. So we could see, Ty, builders' margins expand, which is crazy. So again, I think builders are generally in a much better mood this month than last month.
I would agree. And it's interesting too that maybe with the builders, there is a little bit of a lagging indicator where you said the actual amount of product, deliverables and such may be lagging from the summertime when we hit that 8% peak. Is that for a 30-year mortgage?
It just, builders, it takes a long time to get something going and break it down and stop and pause. And the home builders at least currently look to be in a good spot.
Okay. Well, that's good news. Let's continue. Let's talk about jobs. And I feel like jobs is probably one of the most important indicators. Am I close on that? Is that what are your thoughts? What happened this week?
In my opinion, we get a report every Thursday morning that is going to be like the canary in the coal mine that something's breaking. And it's called weekly unemployment claims. There's lots of reports about layoffs, this, that, the other. It will show up in the weekly claims first. So the last couple of weeks, into December, beginning of January, 202,000. Well, we're now the middle of the month. We heard Citigroup do this, and we've heard tech company do that. And one might expect weekly unemployment claims to spike, to jump, to be going the wrong direction. Well, you would be wrong. They actually came in at 187,000. Lowest since September of 2022. The job market, strong. Again, a point to the Fed, right?
Yep.
I don't know how you can have a March rate cut if retail sales are up and unemployment claims are down.
Interesting.
I can't tie those. It's possible, right? Things could break quick. But just on those two data points from this week, it's like, are you kidding me? Where is the March rate cut coming for this?
Okay. Well, you know what? And I just want to go to this then, and I want to ask you, and we're going to talk about mortgage rates, and then we're going to talk about the $1 trillion default. Of course, we're going to save that for last. But with mortgage rates then, and then even with the Fed rate, this goes back to something you said all last year, higher for longer.
Yeah. So what we've seen this week is more and more positive news, generally speaking. And it gets really weird, right? It's great positive economic news, but it's bad news for rates. If that's, good news is bad news, I guess. So as expected, and frankly, as it should, rates have gone up. Rates are up about, and again, we start with the 10-year, rates are up about 0.2%. So pretty meaningful move for the week. Mortgage rates not that much. What we're seeing is bankers are reducing the margin. So I think mortgage rates for the week are up like 0.08, while the 10 years up 0.2, right? So a lot of that is margin compression. And so rates are up a little bit. I think they're like 6.7, something like that, 6.72. But yeah, so rates up, I'll call it slightly.
Just slightly. Yeah. And so is it safe to say, do you see us bouncing around in the low mid six range into, say, April, May, June with the 30-year mortgage?
I think that would be helpful. I think it would be healthy. Um, Again, I think the March rate cut will be priced out soon, I hope.
Okay.
But I do agree we will have rate cuts this year. So I think what we will have is margin compression.
Okay.
And again, we're still sitting at historic levels. I think the last time I checked, we're at 270 basis points, and 30-year trend is 170. So there's still a lot of room for banks to get, to move that down. Um, I think a 6.5 to 6.75 is healthy for housing. I still sit here today as someone who goes, if we break below 6,
Yeah.
it gets wild. We have crash up. It's not healthy. I want a healthy real estate market, which is just kind of slow and steady for a little while.
Yeah, I would agree. I would agree. And I did a piece on Instagram about it, just kind of following the things our
Yeah,
talking points
very
we've
well
been
done.
talking
I
about.
saw
So
it. It was very well done.
thank you. I appreciate that. Well, I got a good teacher. So let's continue. Let's talk about the big thing. There's two things I want to finish on. Let's talk about the $1 trillion default. What is it, and what does it mean to the one rental at a time community? And also just kind of the timing of how you see it plays out.
Yeah. So again, I think there's a lot of when you hear me talk on my channel, real estate pain, housing pain, I do have a differentiation. When I talk housing, single family homes. When I talk real estate, it's the entire bucket. So here I'm talking $1 trillion or more in real estate pain. And I just had a great conversation on Thursday with Jonathan Twomley, pointing out that PREP, which is a reporting agency, has $1 trillion in commercial real estate pain coming via mortgage resets. And Jonathan's like, Zuber, that's not the half of it. PREP only reports, kind of the class A big stuff. There's a whole pile of pain coming to the 5 to 40 units where you play, which meaning me, right? That's where I play. He plays at the big stuff. I play at the smaller stuff. And he's like, the same thing's coming. TREP just doesn't report that data. So we talked about it more, and it really came down to how the debt was financed, right? You go to a commercial bank, you're buying a 10-unit building in 2020.
Yep.
You got a mortgage rate at 3%. You only got a 5-year loan. That's just how they're financed. So that's going to come to reset in 2025. But the pain starts July of 2024. Why is that? Because what happens is that bank will go to that borrower and say, where's your PFS? Where's your personal financial system? They will then look at the asset. And I want to stress this, even if you've never missed a payment on that 10-unit building, the value on it has fallen because rates have gone up, cap rates have gone up, expenses have gone up, NOI has gone down, where you are going to likely have to bring cash via called a cash in refi to refi that loan. Most small landlords don't have 100 grand sitting around. So they don't have the 100 grand to kick in. So
Yep.
what you're going to start to see in July is the listings come on the market. And unfortunately, I think a lot of the listings will be overpriced. Here's an example. You got a building that was bought in 2020 or 2021 for 400 grand. Today, because of all of the craziness, it's worth 300. The seller can't sell it for 300 because they can't pay commission, they can't pay closing costs, they can't do all of this. So they're going to list it for 350, hoping to get 325 or 330. Nobody's going to pay that. It's worth 300.
Yep.
So you're going to have to get creative. You're going to have to go back to banks. There's a lot of stuff coming. I am excited because I called this over a year ago.
Yep.
I put it out there. I called it good karma. I said, you know what I'd love to do? Continue to buy residential and then let residential run as rates fall. I'll 1031 out into multifamily, just like I did in that book in 2006. I'm going to get to do it again in 2024 and 2025. It's coming.
I love it. I love it. And I just have to say too that, everything that I'm looking at, like Jamie Dimon was on CNBC. There's a big conference going on. I know like Blackstone CEO, he was on talking about the opportunities. First thing he's talking about is commercial real estate, talking about the debt, the restructure. And then also even articles talking about the fact that banks basically are in a position where right now they have to extend and pretend.
Yep.
Right. And they're just going to kick the can down the road. Now, do you see the commercial stuff really falling out? It kind of starts to happen this summer, but really the fallout toward the end of the year. We've talked about this before. Any last thoughts on that?
Yeah, the steps that I see it is the individual borrower goes back to their lending institution. The lending institution says no thanks. The borrower then goes to other lending institution. They say no thanks. They then list it in the summer. The day that it's listed at overpriced, and there's desperation by the end of the year, and true foreclosures start next year. But there'll be pain this year, the second half of this year.
Well, folks, Michael Zuber has been calling this market literally quarter by quarter. And when you've been wrong, Michael, it's usually just because you were way ahead of the time. It was something that happened 6 months later instead of 90 days later. Even billionaire Barry, there was a big thing. He just traded a big piece of his portfolio, the residential, to Invitation Homes. And we know why. It's because he's probably cleaning up messes in the commercial.
So he needs cash. He needs liquidity, exactly, to pay off, to do cash in refis. Absolutely right. You nailed it.
Yeah, spot on. So, Michael, we've got the event coming up in basically 30 days, 4 weeks.
Less than a month.
Yeah, like I'll be getting on a flight to come spend time with you. I'm excited. We're going to spend the weekend. It's a live event. Unfortunately, it's sold out. It's sold out within weeks, but I believe you have a limited amount of virtual tickets. Where can they get a virtual ticket? And then also, do they get the recordings with it?
Yeah, so you can go to onerentalatatime.com. We'll put a link below. It's all there. It's $99. I am committed to giving everybody who buys the virtual a recording. Just so you know, if you are going in person, of course, you will get it as well. And oh, by the way, if you like to save money, buy the virtual ticket, even if you have no plans to watch it that weekend, because I will sell it for more money after the event. But yeah, I posted the agenda. There's 21 millionaires speaking. Figure out who you want to listen to it, watch the others later. I just was at the facility yesterday. It's why I'm in Vegas this week, is to go do a run through, make sure we got the cameras right, the audio right, make sure we can do the Zoom correctly. Yeah, lots of moving pieces. So I'm getting excited, dude. Less than a month away.
Super exciting, folks. So, folks, if you have an interest, this will sell out. There's a limited capacity on the Zoom for him to be able to run the virtual event. Also, you get the recording. So even if you can't attend or you're just going to attend bits and pieces, you'll be there. We're also going to make sure that you get facilitated. If you have questions, we're going to make sure that the virtual room, those questions get channeled and asked to the experts. Michael, thank you for all that you do. Have a great weekend.
Take care, brother. Thanks.
Bye-bye.